everybody's talking about China right now and Hong Kong, and there's a very, very different signal being sent on the platform on which we stand, which is Western economies, and that the platform on which we're standing has been destabilized over the last couple of years, especially, but to a growing extent. But the chopping of the money supply and what we're seeing right now tells us that we're about to experience upheaval in the markets.
Sideways week in terms of fiat US dollar price action for both silver and gold price discovery derivatives. The spot price of silver sold off to close the week's trading and will finish just below 15 fiat Federal Reserve notes per troy ounce. The spot price of gold touched as high as $1,357 this week, only to sell off today into a close of just over 1,340 fiat Federal Reserve notes per troy ounce. The gold-silver ratio finally cleared and closed above the near 30-year high level mark. It now costs over 90 ounces of silver to acquire 1 ounce of gold. In the coming months and perhaps year, we'll likely find out if this key ratio can distort to all-time record levels over 100, which were only reached during the 1930s Great Depression. Coming up, we're going to get a big picture tour of the global economy from returning guest Mr. David Jensen of Jensen Strategic Consulting. If you're a charts and data person or someone who simply subscribes to more common sense economic theories, you won't want to miss Dave's contributions to this week's podcast. Before we begin, a brief word from our show's sponsor. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. We are committed to being your trusted source for low cost, highest quality investment grade bullion products. Visit sdbullion.com for more information.
Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week, a returning guest, precious metals analyst and mining consultant, David Jensen of Jensen Strategic. This interview is being recorded today, Friday, June 14, 2019, at 1:30 p.m. Eastern Time. David, on behalf of our listeners, thank you for taking the time to come back onto our podcast.
Thanks, James. It's good to be back with you.
So, Dave, for today's discussion, you were kind enough to take some time on your end. You gathered a pile of slides and charts for our discussion today. And for audio listeners out there, we're going to do our best to describe the data and the charts that we brought forth. But remember, too, that you can always find the video version of this discussion on our Silver Doctors YouTube channel. So just to start, David, if people haven't heard you on our channel before, just give them a brief background of you, if you could.
Yeah, I started out as an aerospace engineer, and I went back to university in my 30s, and I came out, and in 2003 I started reading Austrian economics, and I never trusted the dot-com bubble in the late 90s. And after I read Austrian school, I had a bit of an awakening in terms of recognizing that we were basically in a debt-fueled bubble and that it was going to continue until the bubble failed. And I transitioned into the mining industry. So I spend most of my time now running a private gold mining company and acquiring assets and developing them in anticipation of a materially higher metal price for both gold and silver. When we get out of this current system, which is utilizing promissory notes to price metals, and I've got a real problem with the way the price is set with hundreds of millions of ounces traded every day in London, but that's another story. So, what I'm speaking to now is just an observation of the markets based upon my experience with the Austrian School of Economics, and I think it's a virtuous view that is telling us that we're heading into an economic upset based upon our pattern of using central banking and committees of people to set interest rates and ultimately create money from nothing. So that's as distilled a description as I can give you there, James.
No problem, Dave. I appreciate you doing that. So you brought forth a bunch of slides and charts, as mentioned. Looks like we're starting here with capital-based macroeconomics and the seminal works of Garrison and Muller. If you go ahead and take it away.
Yeah, I guess the thought is overall is looking at our central banking system. That we're utilizing in the States, the Fed has its dual mandates of stable employment and stable prices, maximum employment and stable prices. And they're doing that by setting interest rates and controlling the volumes of money. And I think if we take a big picture look at what we're doing, we'll see that it's based upon a false assumption that you can create wealth through a credit expansion ultimately. And to do that, I think the first slide, we'll just take a look there at Garrison. Garrison is really the founding, let's say, academic behind the analysis, and then followed by Anthony Muller, who lives, I believe, now in Central America, but he's a German economist who followed on Garrison's works and built on it. And what they pointed out, and I believe rightly, is they show very systematically that when you try to create growth through credit expansion, you're creating consumption where there's no additional consumption, where there's no increase in productive capacity and productive output of your economy. So when you do that, you ultimately, by increasing credit, and this is what the Fed is, their typical prescription is that you need more credit, you just need more money. And we're going lower and lower in interest rates. It was 20% in 1981, and we're down. We've just bounced off of zero, and it looks like they're going to head back to zero again because it's worked so well so far. But they typically just add more and more credit into the economy. And what that does then is it creates this consumption dynamic, which ultimately is based on a credit dependency. It's not because your economy is healthy and you're creating real growth. Ultimately, you're creating debt-based consumption, and your economy is continually dependent upon an increase of this debt availability to both provide the liquidity to service current loans and also to provide additional loans to create additional economic growth. So, and you'll see that in that Federal Reserve chart there of the total credit in all sectors. It's now running in the order of 72 and a bit trillion dollars, and you can see there how it's ramped up, since the early 70s when the U.S. Defaulted ultimately on its gold promises. Mm-hmm. They call it closing of the gold window, but it was really a default on gold convertibility for U.S. dollars. Mm-hmm. So now. In the U.S. economy, and it's not anything special about the U.S. We have Canada and Europe. They've all got the same debt-based monetary systems, but we have now this enormous growth in debt in the economy. And just to give you a sense, James, that if you want to normalize the debt level versus the GDP, it's running about 340% of GDP now, but the historic norm for a very, very long time, for decades and decades in the last century in the States was 150%. And so you've got, in round numbers, about a $20 trillion economy. So that would equate to about $30 trillion in debt was the historic norm. And yet we've got $72 trillion in debt today in all the credit market borrowing that's there. So you've got, ultimately, if you take a very large big picture look at it, you've got about $42 trillion of excess credit in the system and $42 trillion of historic consumption, which was based basically just on continual increase of credit and debt in the economy. So, this has created a great deal of distortion, and maybe we can just go on to looking at, some of the employment figures
Sure.
and the inflation. So now in the States, if you look at the participation rate in the U.S. labor force, there's about a little over 96 million people who are no longer counted in the labor force. And this was done under the Bill Clinton administration in the 90s. They changed the way that we calculate unemployment, so that if you haven't applied for a job in the last 2 weeks, you're not considered to be unemployed. So what that does is it gives you a dramatically lower, when you've got prolonged chronic unemployment in your economy, is that it gives you a skewed view of the true number of unemployed people. And the figures that we get from the BLS these days is that Bureau of Labor Statistics is that you're at near record low, or if not record low, unemployment in the States. But if we look at Shadow Stats, is John Williams' site, shadowstats.com. And if you're looking at the graph there, you'll see in the blue line is the Shadow Stats model, and it's based on the 1990 BLS model that they had in terms of counting the number of people unemployed, including those who hadn't applied for a job in the last 2 weeks. And you'll see that using that prior model of the BLS before they excluded these people is that your unemployment's running at over 21% right now, in the order of that. And I think there's another figure that shows that people on food stamps, what they used to call food stamps, is running about 42 million people right now, which is I think about 16 million more than it was at the time of the great financial crisis.
Yeah, so that's pretty nuts. The idea that 1 out of 5 people who could theoretically be employed, just are not, and the official Bureau of Labor Statistics, they're claiming, unemployment's 3-4% right now, whereas, it's probably 5 times that when you actually dig into the numbers.
Yeah, it's kind of like a child putting their hand over their eyes and saying, "You can't see me," right? It doesn't change anything, right? Just because you're not counting them, and in consumer goods prices as well. I mean, the classic definition of inflation was that inflation is an increase of the money stock or the outstanding money. But if we look at, using the 1980 inflation measure from the Bureau of Labor Statistics as well, and that's the other graph from John Williams there, is that, inflation's running between 9 and 10% right now. We're being told it's about 2.5. I live in Vancouver, Canada. That's what we're told. It's of the order of 2. And in the States, they say it's of the order of 2, and they're having trouble getting inflation, which is a really good thing because it's good to lose the buying power of your money. But it's, we can just see that they've just changed the way that they calculate things. So those are big picture snapshots there of, the run up in the debt to over 70 trillion, the basically runaway unemployment and really punitive consumer goods price inflation that we're all living through because of this distortion that's created by trying for decade after decade to continue growth by just issuing more credit or what some people call just renting money. Right? Renting money is the path to prosperity. If you rent enough, things get really good, and that's not true.
Yeah, that inflation chart that you brought to us, obviously if you look at the Shadow Stats line, that's ever since really the turn of the millennium, around 2000 to 2020 roughly now, it looks like it's been running on an average of around anywhere from 6 up to 11-12% on an annual basis. You do that for 20 years compounding, you're devaluing your currency in a very sleight of hand method. Yeah,
and even if people say, well, we want to use subsequent measures. There's different ways of calculating the unemployment. I mean, I think it's fair to say that your unemployment's running between 5 and 10%, and your inflation is running between 5 and 10% somewhere. Even if you want to say that the 1990 measure of calculating inflation was incorrect, and you can see it in things like rent and people that buy food on a weekly basis. See either the shrinkflation where the packaging contains less of a product or higher prices of a product. So, it's washing through.
Sure.
So it's a failed model that we've been using, and we now see what I believe is that the Fed has taken steps now, which is going to result in, and by the way, the Austrian model predicts that you will have financial collapse and economic upheaval. alone if you continue to try to expand the economy with added credit as your basis for, in air quotes, growth. And I think we're seeing that that the Fed's policy really starting in Q1 2017. And then I believe Powell, if I'm not incorrect, that he became chair in February 2018. He continued this on, but the die was really cast, and I really was disappointed hearing him interviewed a number of times, and he's saying that he's brushing up on things. And when I heard him say that, being chair, that he's brushing up on some economics, it shocked me. And I really, I call him Lee Harvey Powell because of his role as really what I think is a patsy. But he really arrived after Yellen, the Yellen FOMC had implemented policies that I think that are now going to severely cause an upset in the U.S. and in Canada. And I think that Europe is in very much the same shape as well. So let's take a look at that if we can next, the true money supply graph. And that graph, the blue line there, by the way, the true money supply, you can go to Acting Man or you can go to Mises.com and see the explanation for it. But it's really a number which lies between M1 and M2, which are the two figures that the Fed puts out. One is a narrower money stock, and M2 is a little bit of a broader measure. But I think both of those, are incorrect. Now, the Austrians, they talk about base money and things as pure money because it's the money that can't be canceled. We live in a debt-based money system. And if debt is paid off, the money disappears. But, we note that there's never been a contraction, a negative growth rate in the money, and thus the debt outstanding. So I really like the measure, and I think that's the real measure of money, is the true money supply, which is the annual change in the true money stock. But that measure, the true money stock, is based upon all liquid available deposits and all physical cash in the system. And to give you a sense, it amounts to, in round numbers, about $14 trillion in the U.S. economy. And we can see from that graph there that every time that growth has been constricted, the year-over-year growth has been constricted below 5%, it has caused a financial crisis and an economic upset. And the reason is, if you're looking at the money, the liquid money in the economy that circulates, if you've got $14 trillion and your total outstanding debt is of the order of $72 trillion, it creates about a 5-to-1 leverage. And that money, the growth in the money is required both to continue to pay the existing debt, pay off existing interest burden, but also to create the additional debt that's needed to sustain basically what is a Ponzi scheme of an economy where your continued activity is dependent on credit growth. So, the Fed chopped the money supply very, very strongly in Q1 2017. And you can see that they went roughly an 11% year-over-year increase. And it plunged down to about 3% in the summer of 2017. And that's well below, and it's been there, between 3 and 5%, and it's running currently about 3% right now. But that's the level that was tight enough that it caused the prior 2008 great financial crisis and the 2001 dot-com bubble bust. So
right. And I mean, just to throw in there real quick, the last year and a half, we've obviously seen some stock market turmoil. At the end of December of 2018, it was getting crazy there for a minute, and you had interventions obviously that came in with the treasurer talking to all the heads of the banks, et cetera, et cetera. So this has not been sanguine the last year and a half or so. No,
and I think that everybody talks about the great financial crisis is variously caused by Lehman Brothers or the housing bubble failing or Bear Stearns. There's different varying versions as to why we had the crisis, but those were really indicators, or you could call them proximal causes of the market panic. They were the nearby causes, but that the ultimate cause was that the Fed chopped the money supply, the year-over-year growth of the money stock. I mean, it was over 16% in 2004, and by 2006, it had plunged down to about 3%. Mm-hmm. So they basically cut off the oxygen of this debt-based money and financial system, mm-hmm. and it's that tightening of the liquidity that plunges the economy and the markets into chaos, and they've done it again. And it's this chart to me is very concerning, because of the fact that it indicates that the Fed is acting in a more or less a binary fashion. Mm-hmm. They're expanding the money supply, and then they're slashing it down to the level that it causes crisis. Then they're rapidly expanding it, and they're slashing it. And this does not look to me like, I don't believe that a committee can actually set the interest rate and operate the economy effectively. But the way that they're choosing to do it with these wild, rabid swings in their policy indicates to me there's something very wrong with what they're doing. And I'm not sure if they're looking at this measure. I suspect that they are. I think they publish M1 and M2, but they have unlimited funds to study these things, and they've got hundreds and hundreds of economists on their payroll, and they've got to know about the concept of the true money supply and the true money stock and the consequent impact on the economy.
Yeah, that's the age-old question. Are they just obtuse, or are they actually fully conscious of what they're doing?
It's very difficult to tell,
yeah.
But ultimately what they're doing is blowing bubbles, and then they're bailing out. They really serve as an insurance policy. Really, it's gambling insurance. If you could get it, it would be very expensive if you had to buy it, but they're providing it free at the cost of American citizens by basically bailing out the betting institutions, the financial institutions, when the bubbles that the Fed creates collapse, mm-hmm. and they're free to go back and do it again.
Yeah. Well, moving on, it looks like you brought a slide about the personal interest payments going on right now. That chart is rather amazing how large it's grown ever since the great financial crisis of 2008. It's I'm just eyeballing it here. It looks like it's up 20% in terms of personal interest payments since the peak of late 2007.
And then in 2014 it was about $2.8 trillion a year. And then since Q1, or basically since the beginning of 2017, when President Trump took office, it's grown from that point by about $1.1 trillion a year. Mm-hmm. So think about, you're choking off liquidity in a debt-based money system. You're raising rates, but that has a consequent impact as well, in that it drives up the financing costs. And so personal interest payments, as their loans become due and roll over, they've now gone to $4.4 trillion a year, up about $1.1 trillion a year, and rising very, very steeply, mm-hmm. as more and more debt rolls it over into the new interest rate regime. So that's a tax. It's a tax on the real economy. And it's, the payments are going to the debt holders who do well, the financial institutions and insurance companies and whoever's holding the debt. But ultimately, it's a tax on the real economy of the what people call everyday people. But there's an additional $1.1 trillion a year that's hitting them now. And so I think that we're now seeing this wash into the indications are washing into the financial markets. And we're starting to see them in leading indicators of the economy as well, and maybe we can start looking at some of those slides to begin with as well.
Sure. Yeah. Let's roll right into it. Is it Equities is the first slide we're looking at?
Yeah. So the New York Stock Exchange Composite, it's a 2,000 stock composite index. So it's very broad. It measures both large cap as well as small cap companies, and it's because there's so many companies. I think it gives a much better view of the economy than Nasdaq's 100 shares and the Dow's 30 shares, and even the S&P 500 doesn't have a whole lot of small cap companies in it. So we can see there with the vertical line in 2017, that's when the money supply was chopped, and typically you do see a 12 to 24 month lag before the consequences of the cutting of the money supply actually impact the economy. And it takes a while to dry out the financial markets and the economy overall and for that impact to be felt. But we can see, as you mentioned earlier, you alluded to the fact that the markets had let go previously, and we can see there in January 2018 how they dropped, and then they've had a couple of climbacks, but I find it interesting that they've been lower highs by this measure. And this snapshot was taken May 3rd, so there's been a drop in the S&P 500, in the NYSE composite since then as well. So we're continuing on with what appear to be lower highs, as we would expect when the money supply has been chopped the way it has.
There's been go ahead. I mean, I was going to interject real quick. I mean, obviously we've had a ton of share buybacks and financial engineering that have given off the impression, a lot like the BLS's statistics, that the economy is doing just fine. And look at the stock market; it's up and it's high. But ultimately, those debts and that type of financial engineering, it has to pay. It has to come home to roost at some point.
Yeah, it does. The ZIRP, the zero interest rate policy, has ultimately led to great distortions being built into the economy. And this is my concern now: is that the sudden tightening of the money in the economy after such a prolonged period of loose money, creating a heightened or an ultra credit dependency in the economy, is going to have a very strong impact. But I agree with you that the share buybacks and just loose money overall gave these tremendous increases. More than doubling of the New York composite there since the prior crisis. And so everybody's saying now, well, the Fed's going to have to cut rates and that's going to save us. But you can see on the next slide, and this, by the way, came from a website called venablepark.com. I'm not sure what site that is, but I saw it posted on Twitter. But it shows very well, articulates to us that, that the Fed tends to slash interest rates during these market crises, and they really do nothing in terms of preventing the crisis. They're really a knee-jerk reaction, and when the Fed says that they're data dependent, what it means is that they're saying they're not responsible for things and that they're just reacting to what they see. But it's kind of like a driver saying, well, I'm going to turn the wheel when I bounce off the curb, right? We know that there's a 12 to 24 month lag here in these monetary policy changes. And to say, well, we're data dependent means that we're going to react after the fact. And I don't really find it very much of a convincing excuse for what they're doing.
Yeah, it doesn't instill much confidence, the idea of driving, looking through the rearview mirror.
No, and ricocheting down the street and saying, well, that's just what I'm doing.
Right. Well, it's a very good slide. That slide lets you know that, they've already tipped their hand and said we may cut rates. And obviously the market thinks if they cut rates, we're just going to go higher. And this shows you in history, that's not how it goes, Jack. Usually when they cut rates, that means you're on your way down in a severe bear market.
Yeah. I do find it interesting that the two most senior people on the Treasury's plunge protection team quit the week before last as well. So I'm not sure if it's associated with anything here, but the charts and the knowledge of the monetary policy really don't do much to instill confidence in, the concept of equity markets going higher with cheaper rented money to coming. So,
yeah. And just a note on the plunge projection team. I mean, obviously we have a situation now with pensions being totally underfunded, and liabilities that we've promised, but to deliver on is probably going to require some debasement further of the currency and other dramatic things in the economy. So I'm always kind of leery to think that we're going to have another 2008 type crash where it goes straight downwards. I would imagine that the powers that be are going to do whatever it takes to at least slowly let this roll over and support it as best as they possibly can.
Yeah, I think that the one complicating factor there, James, is the fact that we've had these 7 years of ZIRP, and it instills an incredible addiction to continued cheap money. And So we really don't know where that leads in terms of the suddenness. But the Austrian model, that capital-based macroeconomic model, it does predict that you do have a seizure of some time. I mean, this is ultimately what happened to the Soviet Union as well. It's not just the capitalistic economy. It's just that when you consume more than you produce, there is a point that you hit where you can have a step change. Mm-hmm. And so, yeah, I agree that every effort is going to be utilized to provide cheap money and to liquefy things. But I mean, a lot of the tools have been used up to a large, if you want to call them tools. It's a tool of malpractice, but the 2.5% interest rate, I mean, they don't got a whole lot of room to go in terms of, here's some more cheap rented money. Mm-hmm. And, you want to go back into QE again. I mean, you just continually, compound the problem of this loose money malstructuring your economy. And at some point there's a break. And I don't know if this is the one, but I do know that there is the potential here. And all analog and natural systems are prone to this type of thing, whether it's avalanches or if you look at criticality theory overall, that things don't typically in nature fail gradually. Mm-hmm. It's like they fail rather suddenly, and it's the best laid plans. They often can do nothing to compensate for the years and years of malpractice that have gone on. So there is the potential here for really a step change in the economy and a step change in the market. So, and I suspect that's what Gundlach was alluding to. I don't know, but he's seeing higher interest rates in the bond market coming, and I could see how that could happen. You could quickly go to let's say a $3 trillion deficit, plus you're rolling 3 or 5 trillion a year. And I think it's 4 trillion a year in existing debt. I mean, you could quickly be to $7 or $8 trillion in treasury issuances. Mm-hmm. And then when you've got an economy that's seizing up, do you really want that, right? Mm-hmm. People say it's the safest, most liquid asset, but do you want something like that that's backed by unlimited money printing?
Yeah, at some point, what may be the safest may be the riskiest.
Yeah. Yeah, there's all of a sudden a change in perception about, wait a minute, I've just gone running into this room, and I'm going to turn around and go running out of it. And right. I do see the potential is there for the bond market to do just that these plunging rates could all of a sudden turn around. And then you have a tremendous situation on your hands when the confidence is lost.
So on to the next slide, the stocks and Hindenburg omens.
Yeah, so these are omens. They're not perfect, but clusters of them have in the past hinted on, given indications that the markets are unstable and heading for a downturn. And this is from Felder Report, the felderreport.com. And you can see that, up until, I believe this chart's 2 or 3 weeks old, but you can see that these clusters of these have been increasing. So the equity markets are certainly indicating that something potentially is coming at us as well. Mm-hmm.
Mm-hmm. Yeah, we've talked with Jesse Felder a bunch of times on this podcast. He's a bright dude, and his Twitter handle always has great content. So it's a great chart. Yeah.
Bond markets are giving us the same indication. Now we have the inversion of the three month versus the 10-year, and we can see here how these inversions have worked out over the last 40 years, 30 years, 40 years. Basically, each time that they've inverted to the extent that they have now, that we've been facing a recession shortly thereafter, and now indeed here we go into an inversion again.
Yeah, that's 3 out of 3 right there as far as it getting below that you got gold line at 0 and recession soon to follow. So it appears.
Yeah, and I think
go ahead.
Sorry. Yeah, no, I think too that to keep in mind that these things aren't constant over this time is that our credit dependency has been increasing drastically over the timeline of this chart. And that, now up to the 350% of GDP level. So I would expect that the indicators that we have, the economic indicators, is for people to remember that both stocks and bonds, the indicators are not going to behave linearly over time, that the markets won't have the identical reaction as your economy becomes more and more credit dependent, and as the resulting seizure from withdrawal of the credit reoccurs, that you may have very, very different responses in your markets, in your economy. And I do think that this time around will be the greatest downturn that we've had, at least over the duration of this chart, going back to the early 80s.
So it fits with my belief right now is things are only going to get weirder. Basically, you think they're weird now, just wait a few more years. You're going to see things that you never saw before.
Yeah, I think in the markets, it's going to take some creative thinking for people to feel comfortable. And there's going to be some creative explanations as to why they should feel comfortable. So we'll see how it turns out. And further with the bond market, the next chart showing that, when the 3-month has rolled through its 200-day moving average, and this chart was May 24th, and since this chart was created, the 3-month has indeed rolled through its 200-day moving average. So, I'm expecting this now to really pick up steam to the downside in terms of yield. But as I said, I think it could well be that, and there's a lot of people mocking Gundlach for his call for higher rates, but you start seeing, $7 or $8 trillion a year of issuance and a moribund economy, and it's going to change the thinking of investors and insurance, whether it's fund managers or retail investors, about, do I want some of this? Yeah, sure, it was okay when these other circumstances existed, but this is a different situation where we're really seeing some wildness in terms of the Federal Reserve. So,
yeah, no, it's another chart again where it's obvious that twice before this has been a very obvious signal that the markets were going to roll over, and it's starting to look that way again.
Yeah, exactly. So, and now just moving on now to some economic slides, and just to see, are we seeing advanced indicators? But one place to look is auto loan delinquencies on the next slide, and you can see there how, we're at levels that were experienced, at 4.7% delinquent on auto loans, 90-day plus. That's a level that reaches back into the prior recession.
Yeah.
And inventories are the other one that I really think are valuable, because they really serve as an expansion joint between producers and the economy. And so, motor vehicle and part supply inventories as well, we can see that those started to shoot up beginning in 2018. So money supply was chopped in 2017, and then about a 1-year lag, and then the inventories start to shoot up. And that's a Federal Reserve graph. And then to maybe skip ahead a chart there and just look at merchant wholesalers, the inventory to sales ratio. And those are shooting up to levels that existed. And when you think about these inventories, everybody was saying that, new technology and the wired economy, that these inventories would plunge. And now yet we're seeing them rising to levels that were previously experienced during the prior recession in terms of inventory to sales.
Yeah, go ahead. I was just going to say, literally in this chart, it's almost as high as it peaked into the 2008 financial crisis. So that's a bit troubling.
How does that work, right?
Yeah, I know how it works in terms of perception, but in reality, maybe people aren't realizing what's going on.
Yeah. And then lumber and building material inventories too was really surprisingly, we're running about 25% higher than we were just prior to the last financial crisis there. So this is just taking off. So, and then overall the ISM PMI, the Purchasing Managers Index, we're seeing factory orders and the manufacturing PMI itself, rolling over, and the manufacturing PMI has gone negative now. So, and these are things that have a lot of inertia. They don't just turn around and head in another direction, right? And so I find that, people having comfort that the Fed is, or, they will do something, as people typically say to me. And I find that so frustrating, is like, who are they and what are they going to do to have an instantaneous impact, right? You've got basically a binding up of the economy and a seizure of available credit in a credit-dependent economy. what are you going to do now, right? Once this hits, and knowing that it has a 12 to 24 month lag. So it doesn't head in a very good direction overall. I wish I could say something different, but it doesn't look good to me.
Yeah, so I mean, just based on everything we've discussed here, I mean, to me, it looks like defensive posture is certainly warranted at the moment, given all this data. I mean, this is not just some random stuff that we're talking about. This is big picture data. This is the general large scope of the economy, not just the United States, but also globally.
Yeah, it is, and I think, and when we look at, here in Canada, I looked at the CDICs, the Canadian Deposit Insurance Corp, that insures all deposits, I believe, $100,000 or less, and they insure in round numbers about $750 billion of bank deposits, and they hold $4.4 billion of assets. So if you're looking at banks which hold about 85% of their assets are loans, if you have a heavy downturn and those loans become non-performing, what is the loss on that loan portfolio before the banks themselves become insolvent?
Right. And we had discussed in the pre-interview discussion about how, obviously Canada and the United States, all the G20 are under a new supranational law called bank bail-in. It's basically gives the optionality of when a bank goes bust, no more bailouts. Instead, we're going to bail in the depositors.
Right.
And so anyone who's sitting there with, say, over $100,000 in a certain bank and multiple accounts, they'll be getting shares in a newly ring-fenced bank. And good luck.
Yeah.
Hopefully, those shares perform, because you may not get back anything but dimes on the dollar that you had.
Yeah. No, Cyprus, I think, was a good indicator of what happens in these situations. The deposit holders ended up, I think, 25 or 30% of their cash when the hold was released. And the 35% of their deposits were bank stock, which couldn't be sold for 30 or 40 years, I believe. And then 35% was an interest-free loan to the bank for another 35 years. So, I mean, it's, people that want to hold bank stock can just do so by either holding equities in these discount brokerages, I believe, or in holding deposits in the banks themselves. I just don't see in the financial system how this is going to be resolved, given this radical tightening that's been undertaken by the Fed.
Yeah, and on the Canadian bank side, I mean, they're the ones who potentially could be holding a lot of bags with the real estate bubble that's starting to pop up there. Isn't that true?
Yeah, the malpractice by the Bank of Canada, I mean, Mark Carney and subsequent governors, I mean, it's just astounding what has happened here. And the speculation that's gone on. And living in Vancouver, I mean, a 33 by 120-foot lot, with a house that's a teardown, has a value between $2.5 and $3 million, and that's in a middle class neighborhood. I mean, it's astounding what has happened. And Toronto is not a whole lot better. People can say it's Asian money coming in here, but it's not Asian money driving the market in Toronto. And you've got across the country, you've got ratios of house prices versus income, which is completely out of whack. So I think we're at the limits now of a debt-based money system, and I think we're going to have to have it. We're going to have new currencies issued, and I know that Russia and China have been talking about settling bilateral trade between them. It came out an announcement last week that they were going to settle it not with U.S. dollars anymore, and we've got the Malaysian Prime Minister saying that he wants gold for oil. He wants a gold unit to settle the oil trade. And then, I've been looking very closely at the Shanghai Gold Exchange International Board, which is the only legal way to export gold out of China. And to give you an idea, some days they'll do 500,000 ounces in trade on this board, which is a physical exchange. It's not a promissory note exchange. And other days is 2 or 4 ounces traded in the entire day. So, I mean, what that signals to me is that is a store. It's not a trading platform, but it's a place to secure gold. And we can see that over the last month in May, when the sanctions on China, on Iran bit, that the trade there, and Iran continues to export oil to China, but at much lower levels, is that the trade in that market plunged. And I believe that Iran was getting gold for its oil there, and this petrocurrency, the U.S. dollar petrocurrency, I mean, it derives its value as a settlement unit for oil trade globally as the predominant one. And so it's interesting, China, Iran, gold for oil, and who's on the front pages these days, or who are the focal point of international conflict these days.
Right, of course. Yeah.
Shockingly, Iran and China. So. But
I mean, yesterday's news was crazy with that pseudo torpedo attack, which didn't look. Lord knows the truth is the first victim in this story, so Lord knows what happened there. But it is definitely becoming louder and clearer that Iran is in the crosshairs.
Yeah, but it's not going to solve the problem in that America, Canada, and Europe are heading into precipitous decline because of our debt-based money system, and really the fallacy of the theory behind it that you could create growth from additional debt. The additional cheap money is going to make your life better, and that's the foundation of your economy. So we really need issuance of a new sound money system, a new sound money unit, and we need a write down in the outstanding debt here to a level. And I mean, what better person to oversee a write down in debt than President Trump?
Yeah, Mr. Bankruptcy guy himself.
Well, he knows the game. He's known the game for many years, and I think he's the guy to do it. But we do need an issuance of a new non-debt based monetary unit that's stable, and we do need to see this write down in debt occur, so that we can have basically a reset, because it's at a situation right now where you can have complete economic upheaval, and the Austrian model does predict sudden decline, and analog systems, as I mentioned earlier, natural analog systems through criticality theory, we see that they do experience sudden decline. And we saw it in the 29 market failure, and we've seen it recently as well. So, I maybe just close with the last two slides there, one of Putin holding some gold and President Trump holding some gold as well. And I think neither of these people is unfamiliar with this metal and its role as a monetary unit. But I think Trump is under tremendous pressure to keep the system going right now. But I think it's going to become really, it's not going to be an alternative to continue with this system when the consequences are seen. It's just a question of how far the system plunges down. So.
Yeah, if you let it go long for so long, eventually it becomes a mandate for faith and credibility again. And just the point on Putin and on your point about systems and failure, I mean, that's a big driver for his MO, is that he was there when Russia flat out just fell apart and declined suddenly. So it seems like Russia, is probably, of all the nations, the largest trading nations, they're probably in the best situation in terms fiscally. And the amount of gold that they've been acquiring is tremendous compared to their GDP and their M1 and M2 ruble supplies. So
it's not appreciated by Western Europe or the rest of the West that I believe their federal debt is around 20% of GDP. Yeah. Right. So it's making them look bad. But I think it's the only way forward. And maybe just add this additional note is that everybody's talking about China right now and Hong Kong. And there's a very, very different signal being sent on the platform on which we stand, which is Western economies. And that the platform on which we're standing has been destabilized over the last couple of years especially, but to a growing extent. But the chopping of the money supply and what we're seeing right now tells us that we're about to experience upheaval in the markets. And I think that most people are completely missing this because they don't understand that it's not a dial that you can turn. You can't just turn it and vary it and quickly respond. And that the embedded distortion that we have now and the embedded upset that we have from 7 years of ZIRP followed by basically going to near zero or as good as zero on the money supply, when you have existing credit that needs to be sustained and you need to not just roll the debt, but increase the amount of debt that's outstanding to continue the negative growth rate in real terms, it's unprecedented. And so I think, James, that we're heading for a very, very unusual summer here ahead of us. Some friends of mine told me it's going to be in October, but the signs I'm seeing is the slowdown is so rapid that it could just show up on our radar here in the middle of the summer months and be an unusual summer. So,
well, David, thank you so much for coming on behalf of our listeners. I wanted to give them the opportunity to perhaps follow you and to see more of your work. What would be the best way for them to do that?
Well, I post thoughts. I'm not doing very much writing anymore, but I do post my thoughts on Real David Jensen on Twitter. Mm-hmm. So it's just Real David Jensen, Jensen, on Twitter. So I post what I see there, but I don't know how much more there is to post.
Well, I appreciate you coming on and giving us this thorough outlook on what you're seeing and your thoughts. And so I do hope that you'll come on maybe later on in the year and we'll have another revamp.
Absolutely. It was a pleasure talking to you, James.